Good evening, everybody. Running a few minutes behind because of webinar auto technology goofing things up. But we got the great pleasure of having Erick Wilkerson with us tonight, otherwise known as Wolfman. So I'm not going to take up his time. Welcome, Erick. We're anxious to see your information tonight.
All right, you guys, this is a great couple of strategies that you guys can use with Steve Bigelow's information that he gives you on directional assumption. So if you have a directional assumption with a specific stock, then I have a strategy that can be implemented with just about any type of trader, whether you're used to options or brand new to options trading. This strategy will give you the directional bias that you are looking for, and it is a synthetic stock. So we are going to be building out a strategy that performs exactly like the underlying. So what we're going to do is get a couple of things out of the way. My name is Erick Wilkerson, and I've been trading stocks, options on basically all these products and just about all market conditions. Please remember, past performance of any trading system or methodology is not necessarily indicative of future results. You guys can follow me on Twitter at Wolfman's Blog or our parent company at ProTraderStrat. So like I said, let's start out with the synthetic long stock. So if we have a bullish assumption or we come up with a market assumption, we are going to be able to implement this type of strategy. If you're new to options trading, I want to talk about delta. It's the effect of an option premium in relation to the underlying's first dollar move. So think about it as a stock. If you bought 100 of XYZ stock, now that stock goes up by $1, well, you gained $100 in value. Similar with options, every option is worth 100 of the underlying, every one contract. So what we're going to try to do is build out the deltas to be equivalent to 100. Sometimes it's going to be a little bit less, maybe 99. Sometimes it might even be a little bit more, like 101. But we're trying to get as close to the underlying's performance as we can. So it'll be off by just a little bit, but there's so many benefits to using options that it's going to outweigh that one lot that you're not able to implement. But we have that first dollar move. Delta tells us we're going to build this out. And we are going to be able to negate the next three Greeks, if you will. So if you're a little bit worried about that, we're going to be able to offset those. Gamma, just remember, gamma goes with delta. It's on the second dollar move. It adds into that delta, and it's usually in pennies. With theta, it's the impact of premium on time. So what happens is theta is the thief in the night that comes and steals our premiums. Well, we're going to offset that as well because we are going to be buying one option at the same strike we're selling. So theta will offset as the premium decreases on the one we bought, which is going to hurt us a little bit. The premium that we sold in the put side is actually going to help us. So it's going to completely offset it. We don't have to worry about it. And that's how it is going to continue to act like that underlying. And same with Vega. And Vega is just a volatility measure on those premiums. Again, we are going to be able to offset those because we're buying one and selling the other. I just wanted to give you guys a brief overview of that so it doesn't look like we're just trying to get really fancy with this. It's actually very simple. All right, we're going to have a market assumption that's bullish and on the synthetic long stock. So if you are given a setup with the candles that gives you a bullish market move or a signal for a bullish market move, we can implement this synthetic long stock in and around that. And how we're going to do this, we're going to be buying an at-the-money call and then selling that same strike at-the-money put. So, for instance, we are going to be trying to sell a 50 delta call and a 50 delta put. All right, sorry, I'm trying to write real small here. All right, so when we add all that up, we get 100 deltas, right? So just like the stock, and this is on every given one lot. If you're used to doing, 1,000 lot in stocks, then you are going to do 10 contracts because each of these underlying, each one lot in this options is equivalent to 100 of the underlying. So if you're used to doing 100 lots, you're going to do a one lot, which is equivalent to that exactly. Okay? Trying to read some of the questions there. All right, the risk reward, like I mentioned, is the same as a stock position. And that is because if we look at this, when we build out this strategy, we can see that down here at the bottom for Procter & Gamble, I've got Procter & Gamble lined up here. And what I had done, the underlying is trading 124.36. So the at the monies are as close as we can get. And we're talking about the 125 calls and the 125 puts. Now, when we add that up over here, we can see that our deltas are equivalent to 99.34. So that's where I'm talking about. We're going to be about as close to 100 as we can get, and sometimes it's off by decimal points. I mean, we're talking 73 cents for every $100 increase in our position. All right, and if we look up here, we can see this bottom line that is purple. That purple represents the actual stock. Okay, and then the blue line above this is what our position is doing. So you can see they track each other almost exactly to the upside. All right, and to the downside, you are going to lose dollar for dollar every time this stock moves against you. So it's absolutely equivalent to what that underlying is going to do. As you can see here, it really tracks it quite directly. All right, so our risk profile, I mentioned that. The maximum profit is infinite. To the downside, our max loss is if that underlying goes to zero. Now, I'm sure you guys have your risk parameters with this, where you know where your out is on the upside. When you get a signal that says this is topping out, that's usually where you're going to look to cover. And when it breaks a certain pattern, if it breaks below, say, Hangman Doji, then, of course, that's where we would get out of this strategy as well. All right, our break even is the call strike price plus, minus the credit. Excuse me, I have a tickle in my throat. So in that one example I was showing you, we got a credit. We would have to subtract. We would have to subtract it from that strike in order to find out where our break even is. Now the key here is when we're building this out, in that one example, we were getting a indication as to, let me see if I can change the color on this real quick. No, it's not going to let me change it. So we were looking at the underlying being 124.36, and I was looking at buying the calls at the 125 strike, and then I'm selling the puts at that same 125 strike. Now, I would want to, in this case, get a credit of about 64 cents, right? If I got a credit, and I did this for a credit of 64 cents, well, then we subtract the credit from these calls and puts and or, because they're the same strike, and that would give us the equivalent to when it's trading 124.36, all right? So when you're building this out, just know that when you're subtracting that credit, it's really just trying to give you where the break even is, but you want that break even to be equivalent to where the underlying is currently trading. All right? We don't want to be buying this at 125. We wouldn't want to do this for a zero credit because we would be buying it above where the underlying is trading, right? We don't want to do that. We don't want to give somebody arbitrage out there. So when you're building this out, just know that you need to try and build it out for the equivalent to where the underlying is trading. Now, for instance, if we did it for a debit, we would have been expecting to say, all right, if I bought the calls and they were the 124 handle, and I sold those puts at the 124 handle, all right, then I would be expecting to pay a debit, get a debit of, what is that, 36 cents. So I would expect to pay a debit of 36 cents. Therefore, then when it adds in there, it makes it equivalent to the underlying. Is everybody with me so far on that? How we work that out? Okay, good. All right. So I've mentioned this a couple of times. It's the same risk reward as the long stock position. The beauty in this is if you are allowed to trade on margin in your stock account or in your portfolio, then it's going to be about 50% less than what you are accustomed to. So for instance, if you had a $100 stock and you were able to trade that on margin, usually you're going to have to put up about $5,000 for that. Now, with this, you would have put up $2,500. So we are going to be able to use 50 to 75% less capital than what we would normally be accustomed to if we were just going out there and buying and selling stock. And yes, this will work on the futures as well. So with that, if we're paying out less in margin or we're using less capital, then that automatically makes us have a higher return on capital, which is a higher ROC. A lot of people like to keep track of that. You know, basically it shows how much you can leverage your account. Now, this is a good example of the comparison that I was showing with Procter & Gamble. And as you can see here, we did those same strikes with the 125 strikes. And if you were to just buy the stock outright, that would be how much you would have to put up, $6,222. It's about a 50% margin on buying that stock. But if you look down here with the option strategy, you can see that it is even more than a 50% cut rate in someone that has an ability to trade stocks on margin. So the perk, it gets the same performance. You're not going to get that dividend. I don't know if you're too worried about a dividend. Usually with these plays on candlestick setups and or other strategies that give us a directional assumption, we're not in these trades for several cycles. But think about it this way. Yeah, you're not getting that 10 cents for your dividend, but in the same time, you're able to get twice as much leverage out of this strategy, saving you $3,000, which allows you to create a more diversified portfolio, right? I mean, if you're coming up with all of these different directional assumptions, then sometimes when we have a smaller portfolio or have a lot of decisions to make, we have to kind of pick and choose which one we're going to do. Well, with this gives us the ability to do almost twice as many different strategies when we're given a plethora of these different market assumptions based on candlesticks, Fibonacci's, or anything along those lines, right? All right, so it's great for oversold stocks. I'm a contrarian, so that's the one I like to look at. But a bullish assumption or bull market, if you get a candlestick setup, it gives you a bullish market assumption. It's great. Smaller accounts, like I talked about with that, being able to leverage yourself a little bit more than what you would be able to do if you just went out and bought a brand new, or went out there and just bought the stock in your portfolio. And it's great for newer traders. Why? Because we are able to get rid of that theta, right? We are able to isolate that. We're able to get rid of the vega. We don't even have to worry about that because it's isolated. We don't have to worry about if the pricing is appropriate, because I just told you, if we're picking a strike, we need to make sure our debit is going to add into it to give us where the underlying is currently trading. So we all know where the underlying is trading, and we can figure out the pricing of this strategy based on where the underlying is trading, right? If it's a credit, you subtract it from those strikes, and it should equal to where that underlying is trading. So it's great for newer traders. It takes a lot of all of this craziness that we're talking about with, that newer traders get lost in trying to remember the Greeks, that we can isolate all of that and build this strategy out so that a newer trader can easily price this in. All right. Now, like I said, we're going to be buying that at the money call. We're going to be looking for as close to the 50 delta, which is the one that is where the underlying is trading, and selling that same out at the money put. That's just a bit of review. All right. The keys to success. When we're picking the right underlying, I told you can easily price this out. So one of the things I normally say, though, if the stock is greater than $100 stock, if it's over $100, basically what we're going to do is just move that decimal place 3 ticks to the left, and it should, between the bid and the offer and the option montage, it should be about 10 cents wide. All right. So what I'm talking about there, let me see if I can click over to do this. So I'm talking about the option montage. You know, you're going to have all these strikes in there where it's going to basically, you know, for that, if we're looking at Procter & Gamble, let's say, you know, the option montage is going to say like 55, you know, 60. Actually, Procter & Gamble is a lot higher price than this, you know, 65, 70. So the option strikes are going to go like this. What I'm talking about is if this is on the call side and this is on the put side, these options are going to have a bid and ask. So the in the money calls, you know, might be for this one, let's just say they're going to be around, I don't know, I think it's going to be probably around $3. So I'll say $2.95 bid at $3.05. Okay, so that is what I'm talking about. The ones that are at the money on this one are probably going to be something like, you know, $1. Let's just say $1 bid at $1.10. So you can see when you're looking through the option montage, you can see that these are very close to where that rule falls in, where it's less than, equal to, or less than 10 cents wide to the bid offer. All right. And then the ones just out of the money are going to be something like, let's just say these are 20 cents, right? 20 cents at 25. Usually the ones that are out of the money are going to be a little bit tighter, but in this case, we could look at something like this. If the underlying is trading 65, let's just say it's XPG, and the underlying is trading at $65 and even. Well, then on the put side, these puts are probably going to be about 25 cents at, you know, 25 also. So if we sold the calls and the puts, you can see that those pricings are going to offset. These puts that are in the money, again, are going to be probably $1 bid at $1.10. All right. But the idea here is when we're doing these, this is going to be a 50 delta. All right. You know, in that column, it's going to say delta. So that's a 50 delta. And then over on the puts, you know, because it's trading exactly at these strikes, we would have a 50 delta easily. All right. If it was just slightly less, maybe it was it goes down to 64 before we get a chance to do this. Now, this delta right here might downtick a little bit. So in that case, you know, we might actually see this downtick. Let's just say it goes to 45. And then these would go up to probably, you know, now this delta would be 55, okay, or maybe 54. So they're still going to try and offset. Usually if you're just looking straight across at these strikes, you're going to be able to see those strikes, and the deltas are going to, generally speaking, at the monies, are going to be able to add up to about 100 deltas. Okay? So picking the right underlying, one thing we want to do, a stock greater than that, we're going to, so, you know, a $265 stock, we move the decimal place 3 ticks to the left, we're looking at $26, 26 cents for that between the bid offer, okay? All right, the right environment. What I talk about with this one, I usually like to have volatility kind of mid-range. So when we're looking at the vol on these, you know, somewhere in the 20s. But the fact of the matter is with most of my option strategies, I will go through these checklists. All right, we have specific environments. We've got to meet the underlying. We've got to find the right environment. Well, with this one, I already told you, we're able to kind of offset the environment. So we don't have to worry about that one. We can do this in any type of volatility type environment. Right now, we're experiencing really low volatility across the board. So, we're going to be dealing with those low volatility stocks. If it was really high volatility, we're able to offset this. Now, with the right duration, we want to give ourselves enough time to be right. The pricing is going to be basically the same inside of 35 days as it's going to be outside of 35 days. And those different options. Right now, we're looking at, one option expires at 29 days to expiration. And, out the next cycle out is 92 days to expiration. All right. Well, if I'm building this out and it's costing me the same amount of money, why wouldn't I give myself more time to be right? You would even be able to go out to like 183 days or further, depending. So it doesn't matter on the duration. On this one though, give yourself the room to be right. If this starts trending up and we are in a bull pattern, it can go on for a long time. So why limit yourself to only 35 or 30 days? Get out as far as you can. Know that those bid offers are going to get wide out there, but my rule for picking that right underlying is this front month, the spot month, where you're going to see the most time and volume. All right, and you'll be able to click on the time and volume and see that there is a lot of eyeballs in there, and that's what we're really trying to do. But at the end of the day, if the bid offer is really wide way out here, just know you have to set up your pricing so that it's equivalent to where the underlying is trading. It's pretty simple, right? Perfect. All right. The right strikes. Now, I've gone over this a little bit here and there, but the right strikes are the at the money. All right. We're looking for the at the money strikes, and we want to build this out so that it is equivalent to 100 deltas. So what we're trying to do is find the calls and the puts. They both add up. You're going to look at the delta column, and you're going to add those two together and try and get as close to 100 deltas. Therefore, when the stock moves up by $1, we increase our performance by $1. Our portfolio value increases by that dollar. All right. And when we're talking about the synthetic shorts, we're going to build it out just quite the opposite. But again, same rules apply, and we are looking for that 100 deltas. Now, we need to know our exit strategy. Our exit strategy is going to be different for just about everybody. I'm sure that you've heard it time and time again. If you have a higher risk tolerance, then this is your exit. If you have a lower risk tolerance, once it breaks below, say, a hangman doji, you're going to get out. Now, so the exit strategy is something that is different for everybody. Same on the winner or loser, okay? But one thing I always mention is write this down. When you're talking about your exit strategy, and you need to know your exit strategy before you get in. If it pierces a certain level, or you see a certain candlestick pattern, then that's where you get out. Write that down. If I see this, or if I have a price target, if I get to this price target, that's where I'm out. If it breaks below, and most importantly, where's my exit strategy on a loser? If it breaks below a certain level, that's where I'm going to get out. All right? Write it down, because one thing I talk about with trading, and I'm sure you've heard other people talk about, you want to stay mechanical. If you can take the emotion out of trading, you will be much more successful over the long period if you can be mechanical about it and take away the emotion. Because our emotions are tied to money, you guys. I mean, there's no doubt about it. But as soon as you can kind of put that aside and say these are levels and start thinking about it in a mechanical fashion, then you are going to be able to sleep at night for the most part, and you're going to be more successful down the road. All right, so if we are going to look at a short stock position, we can do the same thing when we have a bearish market assumption. Similar to the stock position, we are going to be, though, now selling the call and buying that at the money put. All right. So this gives us dollar for dollar the same type of market movement that we would see with an underlying. One of the same things that goes along, same risk parameters as a short stock position. We're going to use 50% less buying power. Return on capital is going to increase. But one of the beauties of this is when you're trying to short a stock, you have borrowing fees, you have maintenance fees, you got to pay the dividend, all of those crazy things, right? Well, with this, we are able to get away from all of those negative aspects of shorting a stock, all right? And you're going to be able to use less buying power away from your portfolio value. So what I've done here is kind of set it up as the same way. If you were to short this stock, this is actually TLT, that would cost you $6,800. If you were to do this as the synthetic short stock position, it's half of that, more than half of that. It is $3,100. Again, you can see down here, I set it up, the underlying was trading at 137.26. I basically shorted this at the 137 handle, got a credit. So you take that credit and add it to your underlying, and you can see I was probably gave up a few pennies to get into this trade with that credit set up. But it is very close to where the underlying is trading. As you can see, 137.25, and with the way I set this up, it was just about a dime below that. Not too far away, and as a matter of fact, I might have been able to finagle that a little bit better. All right, well, I guess I should ask a few questions here because I kind of rambled through. Usually I try and pull up the platform and give a little bit more detail, but I'm not able to figure out, my computer will not allow me to start sharing my screen. So I'm kind of limited on some of that. I might, no, I'm not going to be able to. So does anybody have any questions so far that I can go over real quick? Brand new to options, Dave. This is the beauty of this strategy is if you're doing the at the money, all of these Greeks, you're going to be able to forget about. So you'll be able to price in, if you're doing the at the money call and the at the money put, then the credit, you add to those strikes, and it should be equivalent to where the underlying is working. How do you get rid of the theta and the vega? Well, because when we're looking at the option montage, and let me see if I can kind of steal it from here. That's going to have the open interest one. The way that we get rid of the theta and the vega is, think about it. If, let me try and go over to the whiteboard again and blow this up. So I'm going to try to erase everything. Let me see if I can just draw a line. Okay. So in this option montage, ooh, what's happening there? Didn't like that. Sorry, guys. I guess I got it on a squiggly line. Let's see if I can just switch pages. All right. So in the option montage, on one side, we have the calls. All right. So we're going to have the calls over here and the puts over here. All right. And we already talked about this. So the strikes are going to basically go 40, 45, 50, and they're the same strikes for the calls and the puts. And let's just say, whatever. I'll just go with that. So if these are the at the monies, all right, if we have theta over here, all right, theta is always a negative. All right. Theta is always a negative to our position. So if these are $1, and $1.05 or whatever, let's just say they're trading last, and these are, let's say, 20 cents, and then the last is 20 cents, and these are trading at around 10 cents or something. All right. So theta is going to be, for these ones that are a little bit further in, let's just say that theta is a negative cents. to this side, right? And over here it could be like a negative 2 cents and then negative 1 cent or something. And these aren't great examples. I'm just kind of pulling from my hat. Well, over here, those same strikes are going to have that theta that's a negative 3 cents, okay? So if we are on the long, let's talk about a long here. So this is for the synthetic long, right? If I buy this strike right here, and let's just say these are $1 at $1.05. All right. So if I'm buying the calls, I buy the call here, right? So I'm buying the call. This theta hurts me, right? So for every day that the thief comes in and steals my premium, tomorrow this premium is going to be worth 3 cents less, right? But over here, I sold these. So we're long this, and this underlying is trading at 40 in this case. All right? The underlying is trading 40 because that would make these the at the monies. But on that side, on this side, I'm selling the puts. So the puts go down in value the same as the calls go down in value. So those are offset. And then Vega is going to be over here, and Vega could be, 0.04 cents. And then over here, Vega is going to be 0.04 cents again. Now, what Vega tells us is when, let's just say Vega is 21. Well, when Vega goes up to 22, goes up 1 percentage point, that Vega goes up 1 percentage point, that means that the premiums increase by 4 cents, right, on this side, and 4 cents on this side, right? Because Vega tells us in that one, it's the increase in volatility. So these, if it goes from 21 to 22, then this adds in, and we sold those, so it hurts. But then over here, we bought these, and our premiums increased. So that's how it's offsetting, okay? Does that make sense? How they offset? I think I got that. Can you review how you get to 100 delta? So anytime we are looking at the option montage, and somebody asked about the option montage, it's that page that kind of looks like this, where you have all your strikes going down, you're increasing like this, and then they're going to have like the delta, they'll have delta, theta, vega, all right, and gamma. Now delta, for these are at the money, so the delta is going to be 50 for these calls that are right at the money, because we said the underlying is trading 40, and then the delta over here is going to also be 50 because those are exactly at the money. Now, if you go slightly out of the money, if we had the 41 strike in here, then this delta might be just slightly less. It might be like 48, okay? And then these, if the underlying was trading there, then these would probably, the delta over here would probably be 52, okay? So basically, if you're using the same strikes very close to at the money, then the deltas will add up to 100. Okay, and the reason why we're trying to get it to add up to 100 is because if you bought 100 of the underlying, that's 100 delta. And each individual stock, one lot, is equivalent to 100 of the underlying. The synthetic short is buy the put and sell the call both at the money. Yes, delta of the call, delta of the put equals 100. Very good, Gary. You're all over it. Have you back-tested this strategy? Yeah, I've back-tested it for at least 25 years, and it works. It is, it's math. The deltas add up to 100. If the deltas add up only to 99, know that if the underlying moves by $1, you're only getting 99 cents out of that. All right. Do you aim for a slight credit? It doesn't matter if you're going for the credit or the debit, actually. As long as I just want, when I set this up, the credit you know, or the debit makes it equal to where the underlying is trading, okay? Well, I never heard anyone use montage outside of movie makers. You can't read anything on the slides? I'm sorry. The whiteboard is, oh yeah, I'm sorry, I didn't know I needed to tell you I was switching over to the whiteboard. You're looking at okay, if everybody has their platforms up, we could kind of go at this one. He's looking at AGIO. Let's look at AGIO. I'm going to pull it up on my platform. And you're looking, so it's trading $47.90. If you buy the January, if you buy the January 50 calls, let me pull up my delta. If you buy the January 50 calls, that's a 39 delta, right? And you're selling the January 50 puts, that's a 60 delta. So you're 99 deltas. So if the stock goes up $1, you would get an increase in your premiums 99 cents. Because as the stock goes up by $1, the delta on the calls goes up by 39 cents, and the delta on the puts goes down by 60 cents, okay? So, you know, it goes up, your premiums in the calls goes up by 39 cents, your delta subtracts from your price on the other side, so that value is a total of 100. How do you use a stop loss? The way to use a stop loss in this, and I don't use stops, I actually always use options. You would buy a put. Okay, you would buy a put at whatever strike level you wanted to have your stop at. My stop is my my mouse, right? But I'm a trader all day long, so I'm keeping an eye on it. Okay. When it's the wrong direction, you're going to want to get out. If it breaks below a candle setup or something like that, then that's where you would want to get out. Yes, Jake's on it. All right, cool. If the out the money costs don't add up, the money makers have their hands in your pocket. Bill is all over it. Yes, that's arbitrage. If you are buying it above where the stock is trading, there is somebody going to fill you on that order. As a matter of fact, if you're having problems, call me up. I'll sell you the synthetic long, and then I'll go and buy the stock, right? And then you scalp that, right? All right. What is the duration? I like to go as far out as I can. You know, if you like to stay in trades for, you know, a year, then I would go out to 360 days. Just make sure that when you're pricing it out that you are pricing it to where the underlying is trading. Sweet spot for duration for me is about 90 days. Somebody is asking, what's the sweet spot for duration? I say it's about 90 days. All right. What is the minimum volume on the options you want? Well, that's a great question. The problem is, you know, there might not be very many eyeballs in there and it's hard to trade. Just know with this trade, you know, usually with what I'm talking about with trading options, I have specific parameters on volume and open interest. And if it fits that rule that I was talking about, remember where I said that if it's over $100 stock, move the decimal 3 ticks to the left, and the bid offer should be inside of that or equal to or less than that, then you know there is a good market maker in there. The guy is making good markets. So you know there's a lot of eyeballs in there. Chris, does that make sense? You don't necessarily for this strategy need a minimum volume, and the reason why is because we can price it out to where it is correct. We can price it out to know that the underlying, or that our pricing lands right in between the bid offer, all right? And you should be able to get filled. So you don't have to worry a whole lot about that. Just don't pay above where the underlying is trading. For my other option strategies, I do talk specifically about how much volume and open interest you need to incorporate a specific strategy for that. But this one, the beauty in it, it's great for a newer trader that is used to just trading stocks and getting that directional assumption trade a stock. Well, this you can use a lot less margin and you're going to get the same risk parameters. You're not going to get a dividend on the long, synthetic long, but you're not going to have to pay the dividend on the synthetic short or hybrid. All right. Yes, you can use leaps, Gary. If you are liking to be in these for, a year or so or 2 years, then yes, you can definitely use leaps. Again, just make sure you're not paying too far above or selling too far below where the underlying is trading. Anybody else have any other questions? I think actually I can scroll down. I think there's a lot more. Did I get everybody's questions? What about the W? Can you sell short for income? Yeah, absolutely. You can sell short for income if you're talking about like creating a hedge or something like that. How would you set a stop on this position? I would normally, if I was worried about a stop on this position, I would go out and buy a put at around the 16 delta. But stick with your strategy. Know where your out is, and then say, for instance, if it broke below a candlestick setup, you know what that price is, that candlestick setup is, then buy a put there if you aren't watching this on a daily basis. So for a trade I look at, I'd like to be buying an option for $1.85 and selling one for $3.50 for a net of $1.65. The underlying is trading at $47.90. So the money by $2.10. The difference being 45 cents. This is the cost of using the strategy. The strikes. What strikes locations are you looking at? Those 50s? Yeah, the 50s, if you did it for $2 and, if you did the 50s, you would, to get it to, yes, if you did the 50s, then you would want the money to be a debit of $2.50, or a credit of $2.50, right? If you're talking about going to the long side, $2.10, I mean. Yeah. Because that would put it right in between. What about weeklies? Yes, you can definitely use weeklies. Just make sure, you're pricing it in correctly. I usually, would go back to saying just make sure it fits that bid offer, remove the 3 decimal place or any stock under $100. Then make sure you go to that. Somebody's asking for my Twitter. It's Wolfman's Blog. What profit percentage do you look for? Well, for me, I'm the same as what you guys are learning here with, candles and stuff like that. I have my profit targets. Like, I think that it might go up to a Fibonacci level or a point of control or, reach a certain price level. Then those are things I look for. I write that down, and same on the downside. If it breaks my candlestick pattern to the downside or a Fibonacci or anything like along those lines, that's where I'm getting out. Okay? Yes, if you're talking about for the margin, you need to look at the stock. So if you're looking at a $50 stock, right, if you are used to being able to buy or sell stock on margin, usually that's going to be about $2,500. With this strategy, it would be about half or a little bit less than that. So it's going to be about, $1,250. Thank you very much, SB, for the kind words. Appreciate it. Sorry I couldn't figure out how to pull up my platform. Next time I work with Steve, I'll have that all figured out. But my computer was not liking it. Wolfman who? I don't know if that's a joke or not. That's what people used to call me on CNBC. So I just picked Wolfman's Blog for my Twitter. Oh, Wolfman's Blog, plural. Wolfman with a S, B-L-O-G. Yes, that's it, Jim. At Wolfman's blog. That's me. You're the Wolfman DJ? I used to listen to you. No. I used to be able to talk like the Wolfman. All right. No, Steve Kernan just started calling me on CNBC when I would do interviews and stuff like that, the Wolfman, so it kind of stuck. Missed afternoon session. JQ's in the house. Cool. All right. Well, without further ado, I guess I'll throw it back to Steve Bigelow. Why did you call him that? Well, if you've seen pictures of me, I used to not shave very much and had scraggly hair, so I think he had a deep voice, and he just started calling me Wolfman. Santelli was in the background. You're right. Gary B remembers. That was when I was on the floor. Now I'm down in Arizona in a sound room. No, it's not a sound room, but in an office. Isn't that profiling? It may very well. Cool. All right, guys. That's about it. I appreciate all your guys' kind words. Thank you guys very much for bearing with me on this. And that's about it. Cool. Thank you, guys. Appreciate it. Bye for now.
Wolfman, thank you very much.